Good morning, folks. Obviously, the big news of the week has been the way the US has imposed tariffs on India and the rest of the world. But we'll come to that towards the end of the podcast. I would like to start with some of the other headlines that have been hitting the week. A discussion on the IT services model that India is following, the special investment funds that are now beginning to hit the street. Let's have a look at what some of them are up to and the pros and cons. There's been a flurry of corporate news, some very interesting stuff that has come up. We'll discuss that. What's happening to the fiscal? The Q1 numbers are out just like the corporate numbers. What's been happening to our Indian fiscal? What's the Fed been up to in the US? Okay, and of course the tariffs, and then a quick look at how the markets have been reacting to all this news. Okay, so let's go ahead, folks. We start with discussion in the Mint. It's actually written by Devina Mehra, and while the news that has been hitting the headlines is how the large majors such as TCS have been laying off employees. Okay, and all because of the advent of the use of artificial intelligence tools. So what does this portend for employment in India? What do the youngsters do? What do the college graduates do? Because this has been such an integral part of the growth economy in India, the services industry, and especially IT. The employment and the disposable incomes that these youngsters have been able to generate has gone on to fuel a pretty large consumption boom in India. Whether it is consumer durables, consumables, property, investments, the whole chain. Okay, and there have been a lot of doomsday predictions that this is going to end the consumption boom. May or may not, the jury is out, because the way economics change, the dynamics of economy, dynamics of nature are very different. We just cannot simply extrapolate these issues. But let us see what Devina Mehra has to say in this. Her basic argument here, at least, is that the IT services industry in India have been very adaptable. They've gone through a number of crises and always come out winners. They have adapted themselves right from the Y2K bug time, when services really took on a big hue in India, to the global financial crisis and various other economic problems that have come out in between. Okay? So one argument is that the IT services industry in India will overcome this too, and a case in point how the large majors such as the TCS, Infosys, Wipro have all developed artificial intelligence platforms which are going to reduce costs and improve productivity for these companies. So just one thing to keep in mind: if companies are laying off employees, it is to protect their margin, correct? So if the margin is going to be protected, who benefits? The shareholder. Yes, the employee is not going to feel good about it, but the shareholder benefits. So let's keep this equation in mind when we look at this, the layoffs that are happening not only in India, across the world. But the big grouse that the author has in this article is that the Indian IT services companies have been cash generating machines. And in spite of the enormous amounts of cash they generate every year, they've hardly invested in research and development. They've hardly gone ahead and figured out how to move up the value chain into products which are more sustainable. The larger successful companies in the West are all making their fortunes on product and not services, whereas India has been focusing on services, and that, given what's happening, may or may not be sustainable is the question. The difference is very stark. Okay, TCS generates over 50,000 crores of cash flow every year and spends only 2,500 crores on research and development. Okay, the R&D spend of Indian IT companies is of the order of 0.5 to 1.1% of their revenues only. Compare this with Microsoft spending 12 to 13 points of their revenue on research. Okay, no wonder they are more successful and could be more sustainable than the IT companies. But this is something I think I'm hoping our IT services companies are going to pay attention to, at least now, and look at it. Of course, the IT sector has been one of the biggest losers in the year to date. Well, largely because of the uncertainty on the US economy, the postponement in decisions by all the large US based companies because of whatever they are facing. They do not know what the tariffs will do to them, whether they're going to get into a recession or not. So they've just held back on all purchase decisions and all services decisions. So that is one reason why IT services companies in India have taken a hit, while the IT companies which are more product driven in the US have continued to go on ahead. Microsoft is a case in point, which has been whose stock price has also been a winner. Okay. Then we have something on the specialized investment fund framework of SEBI, and it is meant to be something like a PMS with a lower investment threshold. PMSs need at least a 50 lakh investment threshold, whereas SIFs will cater to investors who can take a higher risk, but then their minimum investment is only 10 lakh rupees. And asset management companies, the ones who run mutual funds, are allowed to float SIFs also. And since SIFs are allowed to have higher risk embedded in them, there are a number of innovative models that are coming out. Okay, it's so one of the models that are coming out are the long short model, where these funds will be allowed to not only take long position in stocks, they'll also be allowed to short stocks. Okay, that sounds exciting, right? That's what hedge funds do in other parts of the world. And in India too, we have short sellers, but as the authors in this article say, do we have the skill set to do shorting apart from the mindset? So mutual fund managers in India simply have not so far exhibited the mindset. Of course, there's been no opportunity for them to exhibit the mindset of shorting, but then they have been used to long only positions. So if they have an opportunity to do a long short fund, are they going to rise to the occasion and take the opportunities, is one question. And even where the opportunities have been available, where SEBI has allowed shorting, this is in the CAT 3 AIFs, alternate investment funds. The CAT 3 AIFs have not really taken on to shorting. They've still stuck to long only funds. So the authors here, who are part of the National Institute of Securities Market, are putting out pretty pertinent questions. In these long short funds, will the managers be able to effectively short stocks? So let us see, before we rush into this, we need to be figuring out what they actually do. Amongst the interesting corporate news that has been there, the Ambanis who are promoters of Jio Financial Services, have decided to add or infuse 15,825 crores more in Jio Financials, taking their promoter stake from 47.12% to 54.19%. And this will effectively happen at somewhere around 316.5 rupees a share. So it goes to show their confidence in the venture. At close to market price, they're willing to add so much more money. It's, I think, something we should all take a note of. Okay. Amongst the other interesting corporate news is Larsen & Toubro's Q1 results. And here, L&T has shown their classic growth in order book. Okay. And revenue growth, earnings growth, all of it taking place at an efficient ROE also of 17%. Okay, so an ROE of 17% is higher than what Larsen & Toubro has displayed in the past. Okay, so being a cyclical business, it does fluctuate a lot, and at the moment 17 looks juicy for an order book that is growing at a high rate. Okay, so apart from the prospect book, okay, revenues for Q1 grew 16% year on year to 63,700 crores, and profit after tax, net profit, increased 30% year on year to 3,600 crores. This is very good results. Okay, what is interesting to note is the Order inflow grew 41%. Now it has almost a 6 lakh crore order book. That's a big number, guys. Okay. And international, the international orders now form 46% of the book. Not domestic orders, not Indian orders. So Larsen and Toubro, as we all know, has grown into an engineering and execution and construction giant. And it has always had a good presence in the Middle East, especially that is the West Asia. And even now, the bulk of this international order is from West Asia. And we do know that countries like Saudi have been spending a lot on capex. They are trying to do a whole lot of work on their infrastructure development and are wondering, can Saudi be a competition to Dubai, to the UAE, in terms of its offering to the rest of the world? And that's why they are spending a lot. Point to note. So L&T, great news after all this. Okay, and let's see. The other big surprise this week was the Q1 results of Hindustan Unilever. It has been, and this, HUL is considered a bellwether for the FMCG segment, and HUL has been so sluggish for so many years, and suddenly it has displayed a higher than average last few quarters average earnings growth and profit growth. Okay, so while volume growth was almost 5.5%, net profit rose 8%. For a company of that size in a plateauing kind of a business, this is a good number. And the stock also rose 10% in response to these results. We didn't expect HUL as a lumbering giant who possibly is diversified in so many segments with so many hundreds of products. It may be a middling performer, was a thought. So this has surprised people. Okay, so you must understand that the entire FMCG bucket is so wide. Some FMCG companies like Dabur have not done well, where HUL has done well. Different reasons. Dabur has not done well because it derives a good amount of its revenue from the soft drinks segment. And the soft drink segment did not do too well this year because of a shorter summer and early rains. Imagine. Okay. Whereas HUL has been able to do well, and it has also been able to increase margin in some of the areas whereas the food segment have experienced higher inflation, and hence their margins are low. In some of the other cases, the margins have been able to hold. Okay, so that's on HUL. Then we go on to see what's happening to the fiscal deficit in India. Okay, the Q1 numbers have come out for that also. Notable there are that the net tax collections came in at 5.5 trillion rupees, or 19% of the annual target, marginally lower than the 5.5 trillion for the same period last year. So if tax collections are lower, it's because incomes are lower. It's because profits have been lower. So with one single number, we can sort of figure out that growth and earnings has really not been up to the mark as an aggregate. Okay, while there are always pockets that have done well. So let's keep this in mind, which is a reason why markets also have not been too excited. We've spoken about this in the earlier podcast also, how earnings growth has been disappointing. Okay, then of course the government spend on capex has been far more than previous year. While the overall budget is the same at 10 lakh crores, the government this year has been upfronting this spend. And as a result, we are seeing that, so although the GOI's capex expanded by a sharp 52% year on year, okay, it was on a lower base, but then it has, the capex amounted to a healthy 25% of the total budget of this year, okay, which is more than what they did in the last first quarter. This should help the infrastructure businesses in some sense. And the other part is the finance minister reiterating that the fiscal deficit this year will be contained to 4.4% only, lower than the previous year, which is good for inflation, which is good for our macro stability, but sometimes one wonders a little looser fiscal deficit would help growth. And especially at times like this, when we are going through a sluggish period, we are hoping the government would take some steps, maybe in terms of reforms, if not fiscal loosening. Okay, but we of course know the RBI has done a lot in reducing interest rates to help growth, while the fisc has been contained. Maybe it's a good combination. Okay. The other big news was Tata Motors buying over Iveco, which is one of the world's largest commercial vehicle manufacturers. Okay, so they bought this at almost a $4.4 billion. Okay, so immediately one thinks of what the Tata Group did in the around 2006, 7, when they bought over Chorus, they bought Jaguar Land Rover at paying top dollar, and they had to struggle for many years to contain the fallout, the negative fallout of these purchases, because the global economy went into crisis mode immediately after the global financial crisis. So, but one should understand that the Tatas now have the experience of these mistakes, and possibly with this large purchase, they will not repeat those mistakes. So here, Iveco is also cash flow generating business. It is not a loss making business. So in that way, one, it is good. Second, it's almost the size of Tata Motors commercial vehicle business in India. So it's almost like a similar size. So together, whereas Iveco holds a large share in Europe and Tata Motors holds a large share in India, together it would be a global player. It would be one of the largest global commercial vehicle players with a diversified geographic presence, okay? With Asia and Europe both adding to it. So it is something that the management thinks is going to stabilize their cash flows. So one should also remember, as the Indian companies grow larger and grow into the rest of the world, it is the average of their growth that will be on the profits. Okay, so only in India they experienced a high growth rate, but as they spread out, this is going to plateau. We have to keep that in mind. Okay, so Tata Motors and Iveco would have a significant combined global presence with sales of over 540,000 units and over $25 billion in revenue. So here we are getting the making of a global major right from India. Okay. Last week, the Fed met, and there was a lot of anticipation by global markets as to what is the kind of stance they would take. It was a foregone conclusion that they would not reduce rates in spite of Trump shouting from the rooftops and using as crude a language as possible to try and bully the Fed into reducing rates. Okay? But the Fed held its ground and its independence and did not reduce rates. And as the Fed governor rightly believes so, the impact of inflation because of tariffs is not yet known. Okay, and all these things take a few quarters to play out. It takes many months to play out. So they would like to watch that. And in any case, on top of that, the growth numbers for April, May, June growth numbers are fairly good. The labor numbers came a little weaker than expected, a little softer, but still not bad. So all in all, there is a clear case for the Fed to hold off on reducing interest rates. Okay, and if this continues, I think we may really not see any interest rate cuts this year. Okay, given the stance of the Fed and how the US president has been imposing tariffs on so many large countries of the world, markets were disappointed. Global markets fell after the August 1st deadline came by, and the tariffs that came out, as we will speak, a little unexpected, to say the least. Okay, and this has caused gold buying to go up, bond prices to fall, stock prices to fall, everything happened. Okay. And then we come, of course, to the most exciting part of the week, which is tariffs. Trump ended up imposing a 25% tariff on India, even though there were a lot of optimism from different quarters. There were some people who felt it may not happen. that Trump may give some preference to India and have a lower tariff, but that was not to be. Okay, there were some fears given the amount of time it was taken to reach an agreement, and we still haven't reached an agreement, and that is what I was worried about, which I was mentioning in my last couple of podcasts. That look here, we have not yet reached a deal, so I wonder what it's going to be, whether we can be optimistic at all or not. Turns out there was reason for pessimism with the 25% tariff slapped on India, plus the unsaid penalty for dealing with Russia on oil and defense purchases. So Trump has this strange tangential way of hitting. He hit Brazil also with a 50% tariff, saying that they were unfairly targeting the earlier Brazilian president, who was a friend of Trump, for interfering in elections, for trying to rig elections, for trying to pull a coup when he lost. Okay, so he said because of that, Brazil will face a 50% tariff. So there's a lot of interference in other countries' sovereignty, their own systems, and that seems to be the downside of Trump. And he is definitely trying to bully India with his language. Not only him, his entire cabinet, all the secretaries have all been using strong, crude language against India to try and bully India into agreeing. But I think this time around we are holding. We are not going to give it. Okay. So while this 25% tariffs are there, let us remember that there are some sectors which will not fall under this. Okay, so far pharmaceuticals are exempted. Pharma is one of the top export components from India to the US. Then apart from pharma, auto components are exempted. Copper from India is exempted. Electronics are exempted. Okay, what's going to be hit are textiles, gems and jewelry, and other engineering exports. Okay, so while overall analysts say that exports to America will only impact 0.2 or 0.3% of the GDP if they fall. All right, but then while on a very large scale, it may not be having an impact. But just imagine there are so many medium and small size industries who export to the US engineering goods. They will be impacted. There will be so many textile firms. There will be so many gems and jewelry companies who are going to be impacted by this move. So there will be pain felt by some segments. And while as a country, we may be able to sail through this problem. Okay? And as some of the more senior fund managers have been saying, especially in garments, there's a huge margin. And there is an ability for the US buyer to absorb the tariff. Okay, so let's see what happens as far as these things go. And yeah, given all this that has been happening and a sluggish Q1 results, things are just okay. We are not seeing great earnings growth. We are not seeing a great global environment. There's nothing that is conducive to growth. On the other side, business houses are pessimistic and do not have the confidence to go ahead and put up new projects, given all that is happening. This is going to take a lot of time to unravel. The markets that have held up for much of the year sort of gave up this month, and we have the Nifty falling 1% in July, whereas the mid and small cap eventually have fallen far more than the Nifty. And I think for the month, we have seen the Nifty small cap drop by 4% and the Nifty mid cap drop by 6.7%, which is far more. So eventually for the year to date, we have seen large caps outperform mid and small after many quarters of the mid and small outperforming large cap. This is in line with the valuations. Whether it was tariffs or not, the valuations would have eventually led to such an outcome. And that is why we need to be so careful about valuations and not just run away with what's happening with the market. Of course, having a good financial advisor by your side will help you discriminate between fundamentals and what the market likes to do at times. Okay, so that's a wrap for this week, folks. Have a great weekend. Thank you.